The secret to making money on the share market, that was a dramatic pause.
We have built one of the best retail platforms in Australia for Australian investors in the country, with our members now getting 3 amazing services in one place, including InvestSMART's free portfolio services, Intelligent Investors Equity Research, Eureka Report's broad wealth commentary.
We've outperformed the market for 15 years now, and we've done that consistently and by quite a large margin.
Hello, I'm Tony Kaye, the editor of Eureka Report. Welcome to the Economic View. I'm joined as usual by Callam Pickering, our economics writer. Hi, Callam.
Great to be here.
Callam, I wanted to talk about housing affordability and what's being seen in the economy at the moment. It's the hot issue. What are you seeing?
Well, there's a lot of speculation regarding housing affordability at the moment and what the government may or may not do. The unfortunate reality is we don't have a good idea about what the federal government might do when they deliver their budget next week. But I think it's important when we look at housing affordability that we acknowledge that we don't have a national housing market. We have a number of capital city markets, and also house price conditions can differ significantly even within cities as well. So housing affordability measures that may be very good for Sydney or Melbourne may not be applicable to, say, Perth, where prices are actually falling right now. So it's going to become a very tough balancing act, I think, for the federal government and the state governments as they look to approach this issue.
Yeah, and already we know that certain measures are being taken on the regulation side to limit lending, etc. The market seems to be correcting itself in a way at this early stage.
There's some tentative evidence at the moment that maybe house prices in Sydney and Melbourne have slowed a little bit in recent months. It's probably too soon to come to any firm conclusions there, but it certainly appears as though some of the measures introduced by APRA are beginning to weigh a little bit on investor demand, and if that continues, you would naturally expect house prices to begin to ease a little bit.
So let's take a look at rates now. We know that banks have been lifting up their rates independently of the Reserve Bank. What's the Reserve Bank likely to be doing?
Well, right now the Reserve Bank believes that a period of stability for the cash rate is their best course of action. The hurdle for cutting rates again is actually quite high, and I certainly don't think that rate hikes are likely to occur in the next year or two. From the Reserve Bank's perspective, inflation remains a key issue for them. Headline inflation returned to be within the bank's 2 to 3% target, but core inflation, which is the measure the Reserve Bank focuses the most on, was 1.8% over the past 12 months, which is still a little bit lower than the Reserve Bank would be comfortable for. And that's one of the reasons why they certainly couldn't justify a rate hike at the moment.
I know you've said in some of your articles that you're thinking there could be a case for a rate cut. Is that something that you think still could be the case?
Yes, I think there's 2 major reasons for believing that rates may be cut in the future. The first relates to these out-of-cycle rate hikes by the banks. So as they continue to move independently, it does create a little bit more room for the Reserve Bank to cut rates without overheating the housing market. So that would be a potential move for them. The second major reason relates to commodity prices. So in recent months, we have seen commodity prices weaken a little bit after very strong activity over the second half of 2016. Now, as commodity prices decline, it's going to put downward pressure on national income growth. That's going to hit corporate earnings, which in turn is going to hit wage growth. Now, if that occurs, then we would likely see core inflation push down a little bit. So it might go from the 1.8% it is right now back down to that 1.4% level that we saw a few quarters ago. Now, if that was to eventuate, then the Reserve Bank may get a little bit skittish, and they may believe that the economy needs further rate cuts in order to get inflation back to its target.
And then if you have a look at what the banks are doing, they're saying, look, our cost of funding is rising because US rates are rising and other rates are rising elsewhere. And what's the prognosis on the US in terms of the Fed moves?
Well, the Federal Reserve's meeting for the first time since March, and the market doesn't expect them to do anything this time, but they believe that come June, the Federal Reserve is going to hike rates again. So those funding pressures on our major banks is going to continue over the remainder of this year. Currently, the market's pricing in at least another 2 rate hikes for the Federal Reserve over the remainder of the year. So just based on some rough calculations, I would suggest that's going to increase funding costs for the banks by probably 14, 15 basis points. So I would expect them to deliver further out-of-cycle rate hikes over the remainder of the year.
So on the one hand, the banks here will be potentially increasing their rates, and the Reserve Bank could potentially do a rate cut. It's going to create a wider gap, obviously.
Yeah, so the spreads between the cash rate and mortgage rates and business rates are going to increase again over the remainder of this year. But I think it makes sense right now because the banks are reacting to their funding costs pressures, which are independent of the Reserve Bank. The Reserve Bank's obviously interested in, one, not overheating the housing market, but also making sure that the cash rate is at a level that facilitates the economic transition that they're trying to orchestrate. So in this case, they might be very happy for the major banks to hike rates because it partly does the job for them. But they're also obviously worried about the rest of the economy and making sure that that continues to run smoothly.
Oh, thanks, Callam. We'll certainly be keeping an eye on all of this.
Yeah, great to be here.
Thanks for joining me on The Economic View. We'll see you again next time.